Hey everyone, welcome back to Market Meridian. I'm Eric, and today we're diving into one of the most important financial stories of 2026, the private credit crisis. If you're a trader, investor, or just someone who cares about how the global financial system works, this video is for you. It is time for you and me to break down exactly what's happening, why it matters, and most importantly, how you can protect your portfolio as this crisis unfolds. Before we start, let me ask you a quick question. Have you heard about BlackRock or Blackstone freezing billions of investor dollars? Or maybe you've seen headlines about defaults surging or the next 2008. If so, you're already seeing pieces of this crisis, but today, we're connecting all the dots. No jargon, no fluff, just straight, actionable analysis. Let's get started. What even is private credit? Or the basics you need to know. First things first, let's make sure we're all on the same page. What is private credit, anyway? Because if you don't understand the basics, the rest of this crisis won't make sense. Private credit is essentially loans that happen outside of traditional banks. Think of it this way, when a big company needs money, they might go to a bank. But for middle market companies, those with $10 million to $1 billion in revenue, banks often don't want to lend to them. They're too small to issue bonds, but too big for small business loans. So, private credit funds step in. These funds, run by giants like BlackRock, Blackstone, Apollo, and KKR, raise money from investors, pension funds, endowments, high-net-worth individuals, and lend that money to these middle-market companies. In return, the companies pay interest, and the funds pass that interest back to investors. It's been a win-win for years. Investors get higher returns than they would from bonds or savings accounts, and companies get the cash they need to grow. But here's the thing, private credit has grown exponentially over the past decade. In 2016, the global private credit market was worth about $500 billion. By 2025, it hit $1.5 trillion. That's a 200% increase in 10 years. And when anything grows that fast, especially in finance, there's usually trouble brewing. So, to recap, private credit equals loans from non-bank funds to middle-market companies. It's a huge part of the financial system, and it's now in crisis. Now, let's talk about why this crisis is happening. Core causes of the 2026 private credit crisis, the perfect storm. Host, this crisis isn't just one thing, it's a perfect storm of three key factors: liquidity mismatch, AI disruption, and high interest rates plus fraud. Let's break each down, starting with the most fundamental one, liquidity mismatch. Point 1. Liquidity mismatch, the fundamental flaw. Liquidity mismatch sounds complicated, but it's actually simple. Let's use an analogy. Imagine you run a lemonade stand. You tell your customers, you can come get your money back anytime you want, no questions asked. But the money you took from them? You used it to buy a huge truckload of lemons that you can't sell for 5 to 7 years. What happens if all your customers come asking for their money back at the same time? You can't sell the lemons fast enough to give them their cash, and you're stuck. That's exactly what's happening with private credit funds. These funds promise investors quarterly redemptions, meaning you can pull your money out every 3 months. But the loans they make, the lemons in our analogy, have maturities of 5 to 7 years. They're illiquid. You can't just sell them on a stock exchange like a share of Apple. You have to find a buyer, negotiate a price, and close the deal, and that takes time. For years, this worked because investors didn't panic. They were patient capital, they put their money in and left it there. But in late 2025, sentiment turned. Investors started worrying about the loans going bad, so they all rushed to pull their money out at once. Funds like BlackRock and Blackstone couldn't sell their illiquid loans fast enough to meet the redemption requests. So what did they do? They froze redemptions. They said, sorry, you can't get your money back right now. In Q1 2026 alone, over $46 billion in investor capital was frozen. Pause, let that sink in, think about that, billions of dollars trapped, because the funds couldn't turn their loans into cash quickly enough. That's liquidity mismatch, and it's the foundation of this crisis. 2. AI disruption, the unforeseen black swan. Now, let's talk about the wild card, the thing no one saw coming, AI. Artificial intelligence has disrupted almost every industry, but it's hit the tech and software sector the hardest. And guess what? Tech and software are the biggest areas private credit funds invest in. Let me paint a picture. Over the past 5 years, private credit funds poured billions into software companies. They loved these companies because they had recurring revenue, people paid a monthly or annual subscription to use their software. It seemed like a safe bet. But then generative AI came along. Think about tools like ChatGPT, Google Gemini, or Microsoft Copilot. These AI tools can automate tasks that used to require expensive software subscriptions. For example, a company that used to pay $1,000 a month for project management software might now use an AI tool that does the same thing for free. What does that mean for the software companies? Their revenue growth slows. Their cash flow dries up. And if they have a lot of debt, from private credit loans, they can't make their interest payments. That's exactly what's happening. Default rates on direct loans to software companies have jumped from 2.5% in early 2025 to nearly 8% in Q1 2026. Some analysts think that number could hit 15% by the end of the year. Pause, that's a massive jump. And the worst part? Private credit managers didn't see this coming. Their risk models didn't account for AI disrupting entire industries so quickly. It's a classic black swan event, unexpected, but devastating. 3. High interest rates and fraud, the final catalysts. The first two factors, liquidity mismatch and AI disruption, were bad enough. But then we had two more catalysts that pushed the market over the edge, high interest rates and fraud. Let's start with high interest rates. In 2022, the Federal Reserve started raising rates to fight inflation. From near zero in 2022, rates climbed to over 5% by 2025. Now, most private credit loans are floating rate, meaning the interest rate goes up when the Fed raises rates. Imagine a software company that took out a $10 million loan with a floating rate. When rates were 2%, their annual interest payment was $200,000. When rates hit 5%, that payment jumps to $500,000. If their revenue is already slowing because of AI, they can't afford that. So they default. Then there's fraud. In early 2026, a UK-based private credit lender called MFS collapsed. It turned out they were falsifying loan documents, inflating asset values, and lying to investors. When the scandal broke, it sent shockwaves through the market. Investors started asking, if MFS was lying, who else is? They lost trust in the entire private credit industry. So they pulled their money out of every fund, even the ones that were doing things right. That's how a single fraud scandal amplified the redemption wave and made the crisis even worse. So, to recap the causes, liquidity mismatch, the structural flaw, AI disruption, the black swan, and high rates plus fraud, the final push. Together, they created the perfect storm. Now, let's look at what's happening in the market right now, the key manifestations of the crisis. Key market manifestations. What's happening right now? If you've been following financial news, you've seen the signs of this crisis. But let's break down the three most important ones: redemption freezes and fire sales, surging defaults and credit crunch, and market panic and valuation collapse. Let's start with redemption freezes. 1. Redemption freezes and asset fire sales. We touched on this earlier, but let's dive deeper. When investors rushed to pull their money out of private credit funds, the funds couldn't sell their illiquid loans fast enough. So they did the only thing they could: they froze redemptions. BlackRock was one of the first to act. In January 2026, they suspended redemptions in their flagship private credit fund, which held over $12 billion in assets. Blackstone followed a week later, freezing another $8 billion. By the end of Q1 2026, over $46 billion in investor capital was frozen across the industry, but freezing redemptions isn't enough. Funds still need cash to cover operating costs, so they're forced to sell their loans at steep discounts. This is called a fire sale. Right now, private credit loans are trading at an average of 72 cents on the dollar. That means a loan worth $100,000 is being sold for just $72,000. Why does that matter? Because when funds sell loans at a loss, they have to mark down the value of their remaining assets. That lowers the fund's net asset value, NAV, the value of your investment. So even if you're not trying to redeem, your investment is losing value. And that makes more investors want to redeem, creating a vicious cycle. I spoke to a financial advisor last week who had a client with $5 million in a Blackstone private credit fund. That client needed the money for a real estate purchase, but they can't get it. They're stuck, for months, maybe years. That's the reality of redemption freezes. 2. Surging defaults and credit crunch. Next up, surging defaults. A default happens when a company can't make its loan payments. As we talked about earlier, AI disruption and high interest rates are pushing more companies over the edge. The overall leveraged loan default rate hit 4.2% in Q1 2026, that's the highest level since the 2020 pandemic. But the software sector is even worse, with defaults near 8%. And it's not just software, retail, manufacturing, and even healthcare companies are starting to default. Rating agencies like Moody's and S&P are downgrading hundreds of private credit-backed companies every month. A downgrade means the company is more likely to default, which makes the loan worth less. And that leads to more markdowns, more redemptions, and more defaults. But here's the bigger problem: the credit crunch. Private credit funds are now scared to lend money. They're tightening their lending standards. They want higher credit scores, more collateral, and lower loan amounts. That means middle market companies can't get the cash they need to grow, hire, or refinance existing debt. Imagine a small manufacturing company that needs a loan to buy new equipment. They've been a good borrower for years, but now private credit funds won't lend to them. So they can't expand, they can't hire new workers, and maybe they even have to lay people off. That's how the crisis spills over into the real economy. 3. Market panic and valuation collapse. Finally, we have market panic and valuation collapse. When investors get scared, they sell everything, and that's exactly what's happening with business development companies, BDCs. BDCs are publicly traded funds that invest in private credit. They're a way for retail investors to get exposure to private credit without investing in a private fund. But right now, BDCs are getting crushed. The average BDC trades at just 0.78 times its NAV. That means if the fund's assets are worth $100 per share, the stock is trading for just $78. Why? Because investors think the BDC's reported NAV is overstated. They know the fund has illiquid loans that are being marked down, so they're selling the stock at a discount. Some BDCs are even trading at 0.5 times NAV, half their reported value. This panic is also hitting private funds. Some funds are being forced to do NAV haircuts. they're reducing the reported value of their assets by 10 to 20% to reflect current market conditions. If you have $100,000 in a fund that does a 15% haircut, your investment is now worth $85,000 overnight, and for investors who used their private credit fund shares as collateral for loans, they're getting margin calls. That means they have to put more money into their account, or the lender sells their shares at a loss. It's another layer of stress in the financial system, and it's making the panic worse. So, to sum up the manifestations: redemption freezes trapping cash, defaults surging, credit crunch hurting businesses, and valuations collapsing. Now, the big question: is this the next 2008? Let's debate that. Is this the next 2008 or the Great Debate? Host: every time there's a financial crisis, people ask, is this the next 2008? Let's break down the two sides of the debate: pessimists who say yes and optimists who say no. The pessimists: this could be worse than 2008. Pessimists, including some prominent economists and former Fed officials, argue that this crisis could be as bad as 2008, or even worse. Here's why. First, private credit is now a $1.5 trillion market, bigger than the subprime mortgage market was in 2008. The subprime market was about $1.3 trillion in 2007. So private credit is larger, and it's integrated into the global financial system just like subprime was. Second, private credit is opaque. Unlike stocks or bonds, which are traded on public exchanges, private credit loans are not publicly reported. No one knows exactly how many bad loans there are, or which funds are most exposed. That lack of transparency makes it hard to contain the crisis, just like it did in 2008. Third, the leverage is high. Private credit funds use borrowed money to make more loans, which amplifies losses. If the loans go bad, the funds lose more money than they invested. That's exactly what happened with banks in 2008. Pessimists warn that if more funds freeze redemptions, more companies default, and more banks stop lending to private credit funds, we could see a cascading failure that triggers a global recession. The optimists: this is contained now. The optimists, including regulators, private credit industry leaders, and some Wall Street analysts, say the crisis is contained. Here's their argument. First, private credit funds are mostly held by institutional investors, pension funds, endowments, and hedge funds, not retail investors. In 2008, millions of regular people had money in subprime mortgages, through banks and 401(k)s. This time, the investors are sophisticated, they can afford to lose money, and they're less likely to panic in the same way. Second, the sector is better capitalized. Private credit funds have more cash on hand than banks did in 2008. They can absorb losses without collapsing. And central banks like the Federal Reserve are monitoring the situation closely. They stand ready to provide liquidity if needed. Third, the crisis is focused on specific sectors, software, mostly. It's not a systemic collapse of the entire financial system. Most other sectors, like energy, agriculture, are doing fine. So while there's pain, it's not spreading as quickly as it did in 2008. So, who's right? The truth is, we don't know yet. But regardless of whether it's the next 2008, the crisis is already hurting investors and businesses. And that's why the next section is the most important one: how traders can protect themselves. Trader protection strategies: how to navigate the turmoil. Let's get practical. If you're a trader or investor, what can you do right now to protect your portfolio? I'm going to share 5 key strategies, from the basics to more advanced tactics. Let's start with the most important one: avoid direct exposure. 1. Avoid direct exposure to open-end private credit funds. If you have money in an open-end private credit fund, especially one that offers quarterly redemptions, you need to reduce or eliminate that exposure. These funds are the most vulnerable to runs and liquidity freezes. If you can redeem your shares, some funds are still allowing partial redemptions, do it. If you're trapped in a frozen fund, be prepared for a long wait. Historical precedents, like the 2008 crisis, suggest it could take 12 to 24 months for funds to fully wind down or resume redemptions. Instead of open-end funds, consider closed-end private credit funds or ETFs that track private credit, but be careful, we'll talk about that later. The key is to avoid anything that promises liquidity but holds illiquid assets. 2. Short vulnerable sectors and BDCs. 4. Active traders, this crisis presents opportunities to profit from the downside. Here are 3 areas to short. First, BDCs. As we talked about, BDCs are trading at steep discounts to NAV, and they're likely to face more markdowns. Shorting BDCs with high exposure to software or floating rate loans is a smart play. Second, leveraged loan ETFs. ETFs like the Invesco Senior Loan ETF, BKLN, track the leveraged loan market. As default rates rise, these ETFs will underperform. Shorting them can hedge against broader market weakness. Third, software and tech stocks with high floating rate debt. Companies like, example, a mid-sized software company, have billions in debt and are facing AI disruption. Shorting these stocks can profit from their decline. A word of caution, shorting is risky. Make sure you have a stop-loss in place to limit your losses if the market rebounds. 3. Seek safe havens and defensive assets. In terms of crisis, capital flows to safe havens. Here are 3 assets to add to your portfolio. First, short-duration U.S. Treasuries, 2 to 5 years. These are the safest investments in the world. They offer stable returns, and they benefit from expectations of future interest rate cuts, which are likely if the crisis worsens. Second, gold and precious metals. Gold is a traditional hedge against systemic risk and inflation. When financial markets are volatile, gold prices tend to rise. It's a way to protect your wealth when everything else is falling. Third, defensive equities. Stocks in sectors like utilities, consumer staples, and healthcare are less sensitive to economic cycles. People still need electricity, food, and healthcare, even during a crisis. These stocks provide stable dividends and downside protection. 4. Use options for tail risk hedging. For more sophisticated traders, options are a powerful tool to hedge against tail risks, low probability, high-impact events like a full-blown financial crisis. Here are 2 strategies. First, buy put options on market indices like the S&P 500, SPX, or NASDAQ 100, NDX. A put option gives you the right to sell the index at a certain price. If the market crashes, the put option will increase in value, offsetting losses in your portfolio. Right now, the cost of these options is low because implied volatility is still relatively low. That makes them an attractive hedge. Second, credit default swaps, CDS. For institutional traders, buying CDS on major private credit funds or vulnerable banks can protect against default. But CDS are complex, make sure you understand them before using them. 5. Maintain high liquidity and cash reserves. Finally, the most important rule in a crisis, stay liquid. Keep 15 to 25% of your portfolio in cash. Why? First, cash gives you a buffer against margin calls. If your other investments lose value, you won't be forced to sell at fire sale prices. Second, cash allows you to take advantage of buying opportunities. When the market crashes, assets go on sale, and cash lets you buy them at a discount. I've seen too many traders get wiped out because they had no cash reserves. Don't make that mistake. Cash is king in a crisis. Let's wrap this up. The 2026 private credit crisis is a perfect storm of liquidity mismatch, AI disruption, and high interest rates plus fraud. It's causing redemption freezes, surging defaults, and market panic. And while we don't know if it's the next 2008, it's clear that it's hurting investors and businesses. For traders, the key is to protect your portfolio, avoid open-end private credit funds, short vulnerable sectors, seek safe havens, use options to hedge, and stay liquid. Pause for 1 second, before we go. A quick disclaimer, this video is for educational and informational purposes only. It does not constitute financial advice. Always do your own research or consult a qualified financial advisor before making investment decisions. If you found this video helpful, hit the subscribe button and ring the bell to stay updated on the latest market analysis. Leave a comment below. Do you think this is the next 2008? And what strategies are you using to protect your portfolio?